Because I think that the United States and a number of other countries are at risk of going broke, the way countries with reserve currencies go broke. And because I've been investing in the bond markets and other markets for about 50 years and have a lot of experience with this, I've done a study that I want to pass along to you for free so that you can understand it and also understand my recommendations of what should be done. It'll come in 4 parts.
In this insightful video, Ray Dalio shares his extensive research on economic history and its relevance to today's market dynamics. He warns of the increasing challenges posed by debt crises and offers strategies for investors to safeguard their assets amid potential turmoil. Before we dive in, please hit that subscribe button to stay updated on our latest videos. Introduction to economic challenges. Economic challenges are not new. They have shaped societies for centuries. Today, we find ourselves at a crossroads. The weight of debt and the crumbling trust in institutions create a perfect storm. This environment breeds uncertainty. It is crucial to understand how we arrived here. History offers valuable lessons. The patterns of the past can illuminate the path ahead, yet many of us remain unprepared. We must confront the reality of our economic situation. Understanding these challenges is the first step towards resilience. Ray Dalio's historical insights. Ray Dalio has dedicated his career to studying economic history. His insights reveal a cycle of rise and fall. Every few decades, economies face severe disruptions. These disruptions often stem from debt accumulation and wealth inequality. Dalio's research highlights this recurring theme. He emphasizes the importance of historical context. The past informs the present. By examining the mistakes and successes of our predecessors, we can navigate current challenges. Dalio's findings stress the need for vigilance. Ignoring the lessons of history can lead to devastating consequences. Examining internal divisions during World War II. World War II serves as a stark reminder of internal divisions. During this time, societies faced immense economic strain. The left and right factions clashed, leading to extreme populism. These divisions ultimately contributed to the fall of democracies. Countries like Germany, Italy, and Japan succumbed to authoritarian regimes. Today, we see similar patterns emerging. Political polarization is on the rise. The ideological battles of the past echo in our current climate. Understanding this history is essential. It reveals how quickly societies can fracture under pressure. The impact of wealth inequality and debt. Wealth inequality is a significant driver of economic instability. As the gap between rich and poor widens, tensions grow. Those with wealth wield power. They can shape policies to their advantage. This creates a cycle of oppression and resentment. Debt plays a crucial role in this dynamic. When economies are burdened by debt, the potential for crisis increases. Governments may resort to drastic measures. They might print money or impose austerity. Each choice carries consequences. The challenge lies in finding balance. Societies must address both debt and inequality. Failing to do so can lead to widespread unrest. History shows us that unresolved issues can fester and explode. Anticipating changes in daily life. The future is uncertain, but change is inevitable. As economic pressures mount, our daily lives will shift. We must prepare for a world where resources may become scarce. Supply chain disruptions are likely to intensify. This could lead to higher prices and limited access to goods. Capital restrictions may emerge as governments respond to crises. This will alter how we conduct business and manage finances. A world once characterized by free movement of capital may become a distant memory. Moreover, the potential for military conflict looms. Escalating tensions between nations can disrupt everyday life. We must brace ourselves for the impact of these changes. Understanding the historical context can help us navigate the storm ahead. Lessons from history and current events. History is a powerful teacher. It reveals patterns that often repeat. By studying past events, we gain insights into our current situation. The lessons learned can assist in making better decisions today. When we reflect on history, we see how societies react to crises. Consider the economic upheavals of the 20th century. The Great Depression reshaped economies and societies. It highlighted the dangers of unchecked debt and inequality. Today, we face similar risks. Debt levels are soaring and wealth gaps are widening. These issues can lead to social unrest and political instability. Current events echo these historical lessons. The rise of populism today mirrors the turmoil of the past. Economic challenges fuel discontent. People seek change, often turning to extreme ideologies. Understanding this connection helps us anticipate future developments. Strategic actions for investors. In uncertain times, strategic actions become vital. Investors must adapt to changing conditions. One key strategy is to stay informed. Knowledge of historical trends can shape investment choices. The market is influenced by many factors, including political events and economic policies. Investors should also focus on risk management. Diversifying your portfolio is crucial. By spreading investments across different assets, you reduce exposure to any single risk. This approach can shield you from significant losses. It is a fundamental principle that remains relevant. Another strategic action is to remain flexible. The ability to pivot in response to market changes is essential. Investors who cling to outdated strategies may struggle. Embracing new information and adapting to shifting landscapes can lead to better outcomes. Identifying top stocks to hold. Identifying strong stocks requires careful analysis. Investors should look for companies with solid fundamentals. These firms often weather economic storms better than others. Consistent performance and a history of growth are key indicators. Additionally, consider the market environment. Some sectors may thrive during downturns. Defensive stocks, such as utilities and consumer staples, tend to perform well. They provide stability in turbulent times. Investors should seek out these opportunities. Long-term investments can also yield significant rewards. Patience is crucial in the world of investing. Holding onto quality stocks can lead to substantial gains over time. This approach minimizes the impact of short-term volatility. The importance of diversification. Diversification is not just a strategy, it's a necessity. In today's complex market, relying on a single asset can be risky. A well-diversified portfolio includes various asset types. This may encompass stocks, gold, bonds, commodities, and real estate. By diversifying, investors can mitigate risks. When one asset class underperforms, others may excel. This balance helps maintain overall portfolio stability. It is a safeguard against unexpected market shifts. Furthermore, understanding correlations between assets is vital. Some assets move independently, while others may react similarly. Knowing these relationships can enhance your diversification strategy. Aim for uncorrelated assets to maximize protection. Gold, often referred to as a safe haven asset, plays a unique role in diversification. It tends to hold its value during economic uncertainty. This is because gold is seen as a store of value, a hedge against inflation, and a safe haven during financial crises. Including gold in your portfolio can provide a buffer against market volatility. When stock prices decline, gold prices may rise, offsetting losses in other asset classes. This inverse correlation makes gold a valuable tool for risk management. However, it's important to note that gold prices can be volatile. They are influenced by factors such as interest rates, inflation, and global events. Therefore, it's crucial to consider gold as part of a broader diversification strategy, rather than a standalone investment. Understanding economic cycles. Economic cycles are an inherent part of the market landscape. They consist of periods of expansion and contraction. Recognizing these cycles can inform investment decisions. Understanding where we are in the cycle can guide strategy. Typically, economic expansions bring growth and optimism. However, these phases do not last indefinitely. Eventually, contractions occur, leading to downturns. Investors must prepare for these fluctuations. A proactive approach can help mitigate losses during challenging times. Moreover, historical context enriches our understanding of cycles. Past economic events often provide clues about future trends. By learning from previous cycles, investors can make informed predictions. This knowledge is invaluable in navigating the complexities of the market. For those seeking to take control of their financial future, platforms like interactive brokers can provide access to a wide range of investment opportunities, allowing individuals to participate in the market and potentially build wealth over time. Click the first link in the description to learn more. If you're excited to see more content like this, don't forget to subscribe and turn on notifications.